In this video, we're going to be performing a deep dive on Medtronic's dividend safety. To begin, let's talk about Medtronic's business model. Medtronic is the largest manufacturer of biomedical devices and implantable technologies in the world. The company serves physicians, hospitals, and patients in more than 150 countries and has over 86,000 employees. Medtronic currently has 4 operating segments: Cardiac and Vascular Group, Minimally Invasive Therapies Group, Diabetes Group, and Restorative Therapies Group. The $124 billion market capitalization company is on pace to generate $30 billion in revenues and $7 billion in profits. Medtronic is a well-known dividend stock because of its compelling track record of dividend growth. With 41 years of consecutive dividend increases, Medtronic is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, investors cannot rely on Medtronic's dividend history alone to measure its dividend safety. For the remainder of this video, we will discuss the company's current dividend safety from 4 perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. First, let's discuss Medtronic's dividend safety in the context of the company's current earnings. When Medtronic reported its third quarter financial results on February 19th, the company announced that it generated a diluted earnings per share of $1.29 in the 3-month reporting period. For context, the company currently pays a quarterly dividend of 50 cents, which implies a payout ratio of 39% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. Medtronic expects to generate adjusted earnings per share between $5.14 and $5.16 in fiscal 2019. The company is on pace to pay $2 of common share dividends during the same time period for a full-year dividend payout ratio of 39%. Using earnings, Medtronic's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. With that in mind, we will now compare Medtronic's current dividend payment to its free cash flow. Through the first 9 months of fiscal 2019, Medtronic generated $4.9 billion of cash flow from operating activities and spent $799 million on capital expenditures for free cash flow of approximately $4.1 billion. The company distributed $2 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 49%. Using free cash flow, our conclusion is the same as when we use earnings to measure Medtronic's dividend safety. The company's dividend appears safe for the foreseeable future, although we note that its payout ratio using free cash flow is slightly higher than the earnings per share equivalent. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. With that in mind, this section will analyze Medtronic's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by assessing its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Medtronic's performance during this time period is shown here. Remarkably, Medtronic was actually able to increase its earnings per share each year through the financial crisis of 2007 to 2009. With that in mind, we do not have any concerns about the company's ability to continue paying its dividend during future economic downturns. The last angle that we will use to assess Medtronic's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before its free cash flow will no longer cover its dividend payment. At the end of Medtronic's fiscal 2019 third quarter, the company had $25 billion of total debt outstanding. Medtronic generated $726 million of interest expense through the first 9 months of the fiscal year for a weighted average interest rate of 3.9%. The following image shows how changes to Medtronic's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. The following image shows how changes to Medtronic's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As the image shows, Medtronic's weighted average interest rate would need to rise to above the 12% level before its dividend would no longer be covered by free cash flow. With that in mind, we believe that the company's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Medtronic's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.